Alright, now we look at purchase price variance example. During the during the development of its annual budget, the engineers and purchasing staff of Hudson Industrial decided that the standard cost of a green widget should be set at $5, which is based on a purchasing volume of $10,000 for the upcoming year. During the subsequent year, Hodgson only buys 8,000 units and so cannot take advantage of purchasing discounts and ends up paying $5.50 per widget. This creates a purchase price variance of 50 cents per widget and a variance of what? 4,000 for all of the 8,000 widgets that Hudson purchased. How did he get the 4,000? To get the 4,000 here, multiply the 8,000 by the 50 cents. You get 4. Go again. 8,000 times 50 cents variance give you what? 4,000 cents. And the variance is $4,000. Alright. Similar terms now. The purchase price variance is also known as what? Material variance. Material price variance. Alright. Remember those things, please. We look at labor rate variance now. The labor rate variance measures the difference between the actual and expected cost of labor. Alright. It is calculated as the difference between the actual labor rate paid and the standard rate multiplied by the number of actual hours worked. The formula is as follows. Actual rate minus standard rate times actual hours worked equal what? Labor rate variance. Alright. An unfavorable variance means that the cost of labor was more expensive than anticipated, while a favorable variance indicates that the cost of labor was less expensive than planned. This information can be used for planning purposes in the employment of budgets for future periods, as well as a feedback loop back to those employees responsible for the direct labor component of a business. For example, the variance can be used to evaluate the performance of a company's bargaining staff in setting hourly rates with the company union of the next period. There are a number of impossible causes. There are a number of possible causes of a labor rate variance. For example, incorrect standards. The labor standard may not reflect recent changes in the rates paid to employees. For example, the standard may not reflect the changes imposed by a new union contract. Next is pay, pay premiums. The actual amounts paid may include extra amounts for shift differentials or overtime. For example, a rush order may require the payment of overtime in order to meet an aggressive delivery date. Staffing variances. A labor standard may assume that a certain job classification will perform a designated task when in fact a different position with a different pay rate may be performing the work. For example, the only person available to do the work may be very skilled and therefore highly compensated, even though the underlying standard assumes that a lower level person, which is a lower pay rate, should be working the work. Thus, this issue is caused by a scheduling problem. Component trade-offs. Engineering staff may have decided to alter the components of a product that requires manual thereby altering the component of labor, altering the amount of labor needed in the production process. For example, a business may use a sub assembly that is provided by a supplier rather than using in-house labor to assemble several components. Next one, benefits changes. If the cost of labor includes benefits and the cost of benefits has changed, then this impacts the variance. If a company brings in outside labor, such as temporary workers, This can create a favorable labor rate variance because the company is presumably not paying their benefits. The standard labor rate is developed by human resources, social engineering employees, and is based on such factors as the expected mix of pay levels among the production staff, the amount of overtime likely to be incurred, the amount of new hiring at different pay rates, the number of employees retiring, the number of promotions into higher pay levels, the outcome of contract negotiations with any unions representing the production staff. An error in these assumptions can lead to excessively high or low variances. In situations where goods are produced in small volume or on a customized basis, there may there may be little point in tracking this variance, since the work environment makes it difficult to create standards or reduce labor costs. Alright. We look at direct labor rate variance now. The human resources manager of Hodgson Industrial Design estimates that the average labor rate for the coming year for Hodgson's production staff will be $25 per hour. This estimate is based on a standard mix of personnel at different pay rates, as well as a reasonable proportion of overtime hours worked. During the first month of the new year, Hodgson difficult has difficulty hiring a sufficient number of new employees, and so most of its higher paid existing staff work overtime to complete a number of jobs. The result is an actual labor rate of $30 per hour. Hudson's production staff work 10,000 hours during the month. The rate variance for the month is. So the first thing that I will do tell people when they're doing questions, write down the formula first. So the formula for this is, remember, let's go back to it quickly. Actual rate minus standard rate. So it's actual rate minus standard rate times what? Actual hours worked. So this is variance. This is how to calculate it for this one. So the actual rate is what? $30 per hour, right? And the standard would have been what? 25 minus, you get 5, and then times what? 10 hours actual hours work, you get 50,000 direct labor rate variance. Simple as that, my friends. Not hard to do, very easy to do, right? That's about direct labor rate variance. No labor efficiency variance. No, the labor efficiency variance measures the ability to utilize labor in accordance with expectations. The variance is useful for spotlighting those areas in the production process that are using more labor hours than anticipated. This variance is calculated as a difference between the actual labor hours. Again, this variance is calculated the labor efficiency variance. The labor efficiency variance is calculated as the difference between what actual labor hours used to produce an item and the what standard amount that should be have been used multiplied by the what standard labor rate. If the variance outcome is unfavorable, there will likely to be a review by industrial engineers to see if the underlying process can be improved to reduce the number of production hours required using such means as a simplified. So this is where they would how they would combat the unfavorable variance, right? Simplified product design to reduce assembly time, a reduction in the amount of scrap produced by the process, increasing the amount of automation and altering the workflow. It is If this cannot be done, then the standard number of hours required to produce an item is increased to more closely reflect the actual level of efficiency. The formula for labor efficiency variance is actual hours minus what? Standard hours times standard rate equal labor efficiency. variance. Alright? And unfavorable variance means that labor efficiency has worsened, and favorable variance means that labor efficiency has what? Increased. Alright? The standard number of hours represents the best estimate of a company's industrial engineers regarding the optimal speed at which production of staff can manufacture goods. This figure can vary considerably based on assumptions regarding the setup time of a production run, the availability of materials and machine capacity, employee skill levels, the duration of a production run, and other factors. Thus, the multitude of variables involved makes it especially difficult to create a standard that you can meaningfully compare to actual results. There are a number of possible causes of labor efficiency variance. For example, instructions. The employees may not have received written work instructions. Sorry. Mix. The standard assumes a certain mix of employees involving different skill levels, which doesn't match the actual staffing. Training. The standard may be based on an assumption of a minimum amount of training that employees have not received. Workstation configuration. A work center may have been reconfigured since the standard was created, so the standard is now incorrect. Tracking this variance is only useful for operations that are conducted on a repetitive basis. There is little point in tracking it in situations where goods are only being produced at a small number of times or at long intervals. You look at the labor efficiency variance example now. Now look at labor efficiency variance example. During the development of its annual budget, the industrial engineers of Hodgson Industrial Design decide that the standard amount of time required to produce a green widget should be 30 minutes, which is based on certain assumptions about the efficiency of Hodgson's production staff, the availability of materials, capacity, availability, and so forth. During the month, widget materials were in short supply, so Hudson had to pay production staff even when there was no material to work on, resulting in an average production time per unit of 45 minutes. The company produced 1,000 widgets during the month. The standard cost per labor hour is $20. So the calculation of this labor efficiency variance is, remember, go again, the formula is what? Actual hours minus what? Standard hours times standard rate. What you should do is write on these things little before you do the calculation. So it's actual hours minus what? Standard hours times standard rate. Remember, so we'll substitute figures for this, right? So I'm going again. Actual hours minus what? Standard hours. Alright, so in this question, the actual hours is 45 minutes. 45 minutes, right? Not hours. And the standard hours is 30 minutes. Now, what you would do is to convert, anyways, alright? Should have been 750 actual hours minus 500 standard hours. Wait, hold up, so now you may be wondering where this 750 came from, right? No. To first thing you have to do is to convert the minutes to hours, then multiply by 1000. Alright? So therefore, in this case, now we'd have divided to get the actual hours. You're going to divide 45 by 60, because 60 minutes make an hour, right? You get 0.75. Then multiply 0.75 now by 1,000 widgets. because one that was made. Good? And that will give you the 750. Good? Follow me? Let me go again. Let me just type it in so you can see what happens. Alright? So that would be, follow me now, 45 mins, right? Divided by 60 mins. And that would be equal to 0 0.7, 0.75. Then multiply this now by 1000, the 1000 widgets, and that will give you 750 hours. Alright? Then now for the standard hours, divide 30 mins by 60 mins, and that will be equal to 0 0.50. Then times this now by 1000, and you get 500 standard hours. Alright? So that's where you got it from. Good? And when you finish that part now, you subtract the standard from the actual. You would have gotten a figure of 250. You multiply that 250 now by 20, and you get the $5,000 labor efficiency variance. Alright? That's that. So similar terms though, the labor efficiency variance is also known as what? Direct labor efficiency variance. It means it's the same formula, and may sometimes we call what? Though less accurately, the labor variance. That means it's the same formula to do the calculations for that. Alright? Let's move on now. Selling variance overview. The selling variance is the difference between the actual and expected revenue that is caused by a challenge in the price of a product or service. The formula is actual price minus budgeted price times actual unit sales, which is equal to selling price variance. An unfavorable variance means that the actual price was lower than the budgeted price. Good? Because selling price you look at that, right? So the formula again is actual price minus budgeted price times actual unit sales equals to. Alright, so the budgeted price for each unit of product or sale is developed by the sales and marketing managers and is based on the estimation of future demand for these products and services. Alright. In turn, um, and services in turn, which in turn is affected by general economic conditions and the actions of competitors. If the actual price is lower than the budgeted price, the result may actually be favorable to the company as long as the price. So if the actual price is lower than the budgeted price, the result may actually be favorable to the company as long as the price decline spurs demand to such an extent that the company generates an incremental profit as a result of the price decline. Look at the example now, selling price variance example. The marketing manager of Hodgson Industrial Design estimates that the company can sell a given a green widget for $80 per unit during the upcoming year. This estimate is based on the historical demand for green widgets. Net first half of the new year, the price of the green widget comes under extreme pressure as a new supplier in Ireland floods the market with a lower price green widget. Hudson must drop its price to $70 in order to compete and sells 20,000 units during that period. Its selling price variance during the first half of the year is, alright, first thing, remember the formula? Says what? Actual price minus budget price times actual unit sales. Should have been 80 minus, sorry, 70 minus 80. Or would say in this case 80 minus 70. My budgeted is bigger than the actual, right? Times actual unit sales. Alright, so look at it now. Should have been 70 minus 80, which will give you $10. You multiply $10 by 20, you get 200,000. Would have been a negative 200,000 selling price variance. Alright. We look at variable overhead spending variance overview now. The variable overhead spending variance is the difference between the actual and budgeted rates of spending on variable overhead. The variance is used to focus attention on those overhead costs that vary from expectations. Go again. The variable overhead spending variance is the difference between the actual and budgeted rates of spending on variable overhead. Alright? The variance is used to focus attention on those overhead costs that vary from expectations. The formula is actual hours worked times actual overhead rate minus standard overhead rate equal variable overhead spending variance. Alright? Let's go now. A favorable, please write the formula down and know them, alright? A favorable variance means that the actual variable overhead expense is incurred per labor hour or what? Less than expected. For this one. Good? The variable overhead expending variance is a compilation of production expense information submitted by the production department and the project labor hours to be worked, as estimated by the industrial engineering and production scheduling staff based on historical and project efficiency and equipment capacity levels. There are a number of possible causes of variable overhead spending variance. For example, account misclassification. The variable overhead category includes some of which may have been incorrectly classified and so do not appear as a or valid. I have outsourcing. Some activities that had been sourced in-house have now been shifted to a supplier or vice versa. Supplier pricing. Suppliers have changed their prices which have not yet been in updated standards. The variable overhead spending concept is most applicable in situations where the production process is tightly controlled, as is the case when large numbers of identical units are produced. Variable overhead variance is the variable overhead efficiency variance. Alright. So look at variable overhead spending variance example now. So the cost accounting staff of Hudson Industrial Design calculates based on historical and projected cost patterns that the company should experience a variable overhead rate of $20 per hour per per labor hour worked and build this figure into the budget. In April, the actual variable overhead rate turns out to be $22 per hour per labor hour. During that month, the production employees worked 18,000 hours. The variable overhead spending variance is 22 actual variable rate minus 20 standard overhead rate times 18,000 30,000 variable overhead spending variance. Alright. Fixed overhead spending variance overview now. The fixed overhead spending variance is the difference between the actual fixed overhead expense incurred and the budgeted fixed overhead expense. An unfavorable variance means that the actual fixed overhead expenses are greater than anticipated. Alright. The formula for this variance is actual fixed overhead minus budgeted fixed overhead. You should have realized that you can weigh the unfavorable or favorable based on the actual and budgeted. Alright. Now actual fixed overhead minus budgeted fixed overhead now equal fixed overhead spending variance. Alright. The amount of expense related to fixed overhead should the amount of expense related to fixed overhead should be relatively fixed. So the fixed overhead spending variance should not theoretically vary much from budget. However, if the manufacturing process reaches a step cost trigger point where a whole new expense must be incurred, this can cause a significant unfavorable variance. Also, there may be some seasonality in fixed overhead expenditures, which may cause both favorable and unfavorable variances in individual months of a year, but which cancel each other out over the full year. Other than the 2 points just noted, the level of production should have no impact on this variance. This is one of the better cost accounting variances for management to review, since it highlights changes in costs that were not expected to change when the fixed cost budget was formulated. Here is an example of fixed overhead spending variance. The production manager of Hudson Industrial Design estimates that the fixed overhead should be $700,000 during the upcoming year. However, since the production manager left the company, was not replaced for several months, actual expenses were lower than expected at 672,000. This created the following favorable fixed overhead spending variance, as you can see, 28,000 negative fixed overhead spending variance. Alright, look at material. I was finished with this video now. Just bear with me a little bit more. Material yield variance overview now. The material yield variance is the difference between the actual amount of material used and the standard amount expected to be used, multiplied by the standard cost of the materials. Alright. Formula is actual unit usage minus standard unit usage times what? Standard cost per unit. Alright. An unfavorable variance means that the unit usage was greater than anticipated. There are a number of possible causes of a material yield variance. For example, scrap, material quality, spoilage, freighting issues. You can read this back on your own. So scrap, usually amounts of scrap may be generated by changes in machine setups or because changes in acceptable tolerance levels are altering the amount of scrap produced. A change in the pattern of quality inspections can also alter the amount of scrap. Material quality is material quality level changes. This can alter the amount of quality rejections. If an entirely different material is substituted, this can also alter the amount of rejections. Then you have what we call spoilage. The amount of spoilage may change in concert with alterations in inventory, handling, and storage. Freight in issues now. This transport service that ships materials to the company may have damaged them in transit, rendering them what? Unusable. The standard unit usage is developed by the engineering staff and is based on expected scrap rates in a production process. The quality of raw materials, losses during equipment setup, and related factors. Example now for material yield variance. The engineering staff of Hodgson Industrial Design estimates that 8 ounces of rubber will be required to produce a green widget during the most recent month. The production process used 15,000 ounces of rubber to create 35,000 green widgets, which is 9 ounces per product. Each ounce of rubber has a standard cost of 50 cents. 50 cents. Its material yield variance for a month is would have been 250 ounces minus 280,000. Why 280,000, by the way? Because you apply 35,000 by 8, you get 280,000. Alright? To get the 315,000, would have been 35,000 by 9. So to get this, you multiply 9 times 35,000 to get this, right? To get the 280, you multiply by 8 by 35,000. Because your amount was created. And then minus them, you multiply them by 0 by 50 cents. So it's the total cost per unit. And you get a material yield variance of 17,500. Alright. Alright, thank you very much for watching this video clip. Look forward for the other ones coming up.